Today, we are taking a deep dive into American Battery Technology Company, or ABAT. This is a company sitting right at the epicenter of a massive shift in American industrial policy. So the big question we're going to tackle is this: is this a once-in-a-generation investment opportunity, or is it all just hype?
Okay, let's really get into this, because our entire analysis today really hangs on this one single powerful question. What we're witnessing is a seismic policy shift coming out of Washington, D.C. It's not just some minor regulatory tweak. This is a deliberate, calculated effort to completely rewire the clean energy supply chain and bring it home. And for investors, well, that could signal a whole new kind of gold rush. So here's how we're going to break it all down. First, we'll look at what we're calling the new American gold rush. Then we'll get into the weeds on ABAT's business and, of course, the risks. After that, we'll crunch the numbers that matter, see what the analysts think, and then we'll deliver our final verdict, and we'll even give you an alternative way to play this trend. Let's jump in.
To really grasp the opportunity with a company like ABAT, you have to understand the new battlefield it's playing on. This isn't your typical free market. Washington has fundamentally rewritten the rules of the game, creating some incredibly powerful tailwinds for a very specific type of domestic company.
You know, what's really striking here is just how fast all this happened. It really kicked off with the 2024 graphite crunch. China flexed its muscle, restricted exports of this key battery material, and sent a massive shockwave through the entire EV industry. That wasn't just a warning shot, it was the catalyst. It forced a response, and that response came hard and fast in mid-2025 with this landmark new act. And just like that, by the end of September, the old EV tax credit that everyone knew was gone.
And this is the absolute crucial point. The whole strategy pivoted. That famous $7,500 tax credit for buying an EV terminated. Instead, all those billions of dollars were rerouted, funneled directly into things like the Industrial Base Fund and the National Defense Stockpile. The message from Washington could not have been clearer. We are done incentivizing buyers. From now on, we are directly funding and protecting the domestic companies that are building our supply chain from the ground up.
And that brings us right to the doorstep of American Battery Technology Company. They're focused on recycling lithium-ion batteries and mining for primary battery metals, all right here at home. So with this new industrial policy as the backdrop, is ABAT the pioneer that's perfectly positioned to capture this moment? Or is it just a company that's getting caught up in the hype?
Before we get into the nitty-gritty, let's just frame our whole analysis with this timeless piece of advice from Warren Buffett. He's always looking for a moat. You know, that durable, competitive advantage that protects a business. So, in this brand new world, what exactly is ABAT's moat? And this slide, right here, just perfectly illustrates the core tension of this investment. ABAT's moat is basically its passport. As a domestic U.S. company, it's designed from the ground up to be compliant with the strict new Foreign Entity of Concern rules, or FEOC rules. That gives it a massive, protected home field advantage. But the risks are just as stark. First up, execution risk. This is still an early-stage company. Can they actually build out the factories and scale up fast enough to meet this opportunity? It's a huge question. Second, policy risk. The same government that created this amazing opportunity could, change the rules of the game again down the line. And finally, there's a bigger market worry. Killing that consumer credit might cool down overall EV demand, and that would hurt everyone in the supply chain.
Okay, let's pivot to the financials. A great story is one thing, but as investors, we have to know what the numbers are telling us. This section is all about giving you the right tools to analyze the company's financial health for yourself.
And right off the bat, we've got to be completely upfront with you. The source documents we used for this analysis didn't include detailed, up-to-the-minute financial statements. And honestly, that's a pretty critical piece of the puzzle that's missing.
But you know what? This limitation actually gives us a chance to do something even more valuable than just reading off a spreadsheet. We're going to walk you through the exact metrics, the key numbers you need to be looking for the second that data becomes public. Think of this as your investor toolkit.
All right, these are the 4 big ones you have to watch for a company at this stage. First, revenue growth. You're not just looking for growth, you want to see it accelerating as they switch on new facilities. Second, gross profit margin. Look, early on, this might be negative, and that's okay. The key is seeing a believable path to positive margins, ideally somewhere north of 20 or 30% as they scale up. Third, debt to equity. Yeah, a high-growth company is going to use debt, but if that ratio is consistently over 2.0, that can be a real red flag. And finally, free cash flow. The analogy in the source material is perfect. Just think of it like your personal budget after all your necessary bills are paid. Is there any cash left over? Right now, ABAT is probably burning through cash. The big question isn't, is it positive today? It's, is there a clear, credible path to generating cash in the next few years?
So,
Since we can't build our own financial model from scratch, we're going to turn to the next best thing. What does Wall Street think? Let's look at the consensus view from the analysts who actually cover this stock. What are they projecting for the future?
And what we see, based on data from AlphaSpread, is a remarkably tight consensus on Wall Street. The average 12-month price target is sitting at $7.14. And look how narrow that range is. The low end is $7.07, and the high is just $7.35.
So what does that average target of $7.14 actually mean for an investor? Well, from the stock price at the time of this report, it represents a potential upside of 93%. Let that sink in. 93%. That is a massive signal from the analyst community that if, and it's a big if this company can execute on its plan, there is some serious value to be unlocked here.
But we have to balance all of that optimism with the single biggest threat that's lurking out there. It doesn't matter how great U.S. policy is, a severe global recession that just crushes consumer spending would absolutely slow down the adoption of EVs. And if people stop buying electric cars, the entire domestic supply chain, ABAT included, is going to feel that pain.
All right, so we've looked at the big picture, the company's unique advantage and its risks, the financial framework you should use, and what the analysts are predicting. It's time to put it all on the scale and weigh the evidence.
And really, it all boils down to this simple conflict. The bull case, the strongest argument for investing, is that the U.S. government has essentially built a walled garden. It's a protected market where domestic players like ABAT have an unbelievable home field advantage. The bear case, the single biggest risk, is that a golden opportunity is completely worthless if you can't actually seize it. As an early-stage company, ABAT is staring down a mountain of execution risk.
So after weighing that powerful tailwind from industrial policy against the very real risks of an early-stage company, our verdict is a buy with a 12-month price target of $7.14. We believe the competitive advantage that's been literally created by the government is significant enough to outweigh the execution risks, making this a very compelling high-risk, high-reward opportunity.
Now look, an investment like ABAT, with its risk profile, is definitely not for everyone. But if you believe in the underlying trend, this huge push to onshore the entire battery supply chain, there are other ways you can invest in it.
First, take a look at a company like NextSource Materials. This is a much more focused, and you could argue a more de-risked way to play this. Instead of betting on a broad tech platform like ABA, you're investing directly in a critical material, in this case, graphite, from a company that already has an existing mine and offtake agreements. Now, the potential upside might be a bit more contained, but the execution risk is a whole lot lower. Then you have a company like T1 Energy, which is in the solar sector. Now, this isn't a direct competitor, but it's a fascinating strategic parallel. As a more mature company, it's a great case study of a business that is already successfully navigating these same complicated FOEC regulations. So for a more conservative investor who likes the trend but is nervous about early-stage companies, T1 is a more stable, established way to invest in those same powerful government tailwinds.
Look, the onshoring of America's industrial base is, without a doubt, one of the biggest economic stories of our time, and it is creating a brand new landscape of winners and losers. The question is, who's going to come out on top? Let us know in the comments what company you think we should put under the microscope next.